One of the main differences between traders who last and traders who disappear is that traders who last are completely okay with taking small losses. And I know most people say they're okay with it, but trust me, there are levels to this. The traders who last don't negotiate it, they don't give it room, they just take the small loss, like paying for a ticket, and they move on. If you can learn to actually love losses because they protect your career and put you in a situation where you could take those A-plus trades, then your results will change permanently. Most traders feel like they're not emotionally allowed to be wrong. Your brain treats a small loss like a personal failure, so you avoid it, and then you end up taking a huge loss instead. It's not your fault, it's human wiring, and the solution is to rewire your relationship with losses. Make small losses normal, procedural, and non-negotiable, then use stop rules and sizing rules as the mechanical enforcement for that. In this video, I'm going to show you exactly how to do that, how to become genuinely, mechanically okay with losses so you take the right loss on time every time, which keeps you out of major losses and keeps you in a position to take that A-plus trade when it finally comes. This episode is about neutralizing the biggest bug in trading, because the market doesn't need to beat you. Your own wiring will do it for free, unless you understand what is happening and how to train yourself to change it. Let's get into it. Today, we're talking about our relationship with losses and how to train ourselves to override that human bug that causes us to cut winners and double down on losers. One of the most common things in trading is a disproportionate relationship between the size of your losers and the size of your winners. Even if you do have a good trading strategy, most traders find themselves taking outsized losses repeatedly that wipe out weeks of gains, if not more, and make it really hard to build that consistent performance. And the thing is that most, if not all of those major losses, when you look back at them, you know that you did something wrong. You know you should have cut that loser way before it got that big, but something inside of you stopped you from doing it. Something inside of you caused you to wait or add or widen your stop until you took that outsized loss. And because it's so common, it's so human, it's a part of our human wiring, then people already did the research on it. There are two things you should probably know. One of them is called the prospect theory, and the other one is called the disposition effect. According to prospect theory, when you're down on a position, your brain becomes risk-seeking in order to avoid realizing the loss. You hold your loser way too long, you widen your stop because you don't want to accept the loss, you add to a loser and you take big risks in order to just break even. And according to the disposition effect, you cut your winners quickly because you want to lock in that feeling of good, of I made something, I did something good. And you hold on to losers way too long for the same reason in reverse, because you don't want to lock in that feeling of bad, of, oh, I lost or I'm wrong. So prospect theory is the wiring and the disposition effect is the behavior that it creates. And if you rewire your brain's loss response, you weaken both of those things. And if you weaken both of those wirings, then you can take the right losses at the right time and never find yourself with too big of a loser. So the problem isn't that you're dumb or weak or anything like that. The problem is that you're human, which means that the fix is a system that makes making the right choice easier for your brain to do. Now, what's a good kind of loss in trading? A good kind of loss in trading is leaving your position around the time that your thesis is invalidated. Today isn't a full stop-loss placement masterclass. We're covering stops at the concept level as enforcement of the mindset. I'll create a deeper stop-loss placement video later on. For today, I'm going to assume that when you entered a trade, you knew what you wanted it to do, and at some point you knew that it's not doing what you want it to do, and that it's looking very unlikely that it will do what you want to do. And that is the moment of the thesis invalidation. That's the moment where all of us need to leave our trades, but most of us don't. Now, going into trading, you know that your batting average is going to be much less than 100%. Your job is not to be right all the time, and you know that. Your job is to protect the positive expectancy of your trades across hundreds and thousands of trades. And the way for you to protect the positive expectancy of your trades as a whole is to have reasonable risk for the trades that you take, and then actually respect that risk when you're wrong. And again, I know that this sounds obvious, but as obvious as it sounds, I also know that most people fail at this. So let's look at specifically how people fail at this. The biggest issue is the negotiation spiral. The negotiation spiral is the most common path from a normal manageable loss to a really bad loss. What normally happens is that the price does something that puts you slightly red and starts going towards your thesis and validation area. And what you should do in that moment is accept the planned risk and get ready to stop out if the thesis and validation happens. But what happens instead to a lot of us is that we start to emotionally monitor the P&L. Ego and pain kicks in. Your brain starts thinking about all the negative things that this loss will do. You start projecting it onto your life, onto your future, onto your self-worth and self-image. So you don't take the loss where you should. You widen your stop a little bit. Or maybe you add to your loser where you should be cutting it. This is exactly what the prospect theory behavior tells us. That once you're in the red, you're willing to take larger risks than you would have before just to avoid being red. All of a sudden, you're willing to take a position that was larger than you planned or a wider stop than you planned. You delay taking the loss that you already should have taken. You start trading off of hope instead off of what you see and what the market is telling you is happening right now. And while sometimes that behavior will bail you out, it reinforces a bad lesson because eventually if you keep trading, you're not going to be bailed out. And eventually what happens is if you widen your stop or if you added to the loser, or if you did any of these things that we tend to do in those situations and the price continues to go against us, at some point you find your max pain moment. And then you take that major loss and you're like, fuck, why couldn't I have just taken the small loss when it came? Why couldn't I have just accepted being wrong when I was wrong? And look, I get it. I know exactly how it feels. Taking a loss sucks. Ending the day red sucks. In that moment where you look at the P&L and you feel it in your chest like you just set yourself back, sucks. And this is where people accidentally attach trading to their self-worth. They don't just feel like I lost money. They feel like I failed, I'm behind, I'm not good at this. But the truth is that the manageable loss is the healthy pain. That's the pain that keeps you in the game. It's the pain that prevents career-ending loss. It's the pain that makes sure that when the H rate comes, you'll be able to take it. Your job isn't to eliminate that feeling. Your job is to make the correct response automatic even while you're feeling that feeling. And it's a lot easier to separate your life from your trading results when your losses are controlled and planned. Because then a red day is just a business expense, not a crisis. And the reason why small losses become big losses is because we start negotiating after we're wrong. The negotiation is the problem. So if negotiation is the enemy, the solution has to be to remove negotiation. And one of the cleanest ways to remove negotiations is to use automatic stops. That's what I use nowadays. If you already know where you're going to be wrong, there's no reason to wait until you're emotional to decide. Put the stop in immediately and let the system execute it. Now, I know that that's a general statement because maybe you're trading the kind of stuff that wicks a lot, or maybe you're trading some other kind of strategy that makes automatic stops less ideal. So if automatic stops are not for you, that's fine, but then you have to be very, very disciplined about your stops when they do come if you have to take them manually. And there's also the option to put in stops for half of your size or part of your size. That way, at the very least, you know that part of your size has been taken off when you seem to be wrong, and the rest you can use the 5-second rule that I'll touch on later to decide what to do with it. Stops are not a random number, they're an invalidation point. They're the moment where your trade thesis starts having a negative EV. So the framework for each trade needs to be that number one, you have a thesis for the trade, a clear thesis, and as a derivative of that thesis, you should have an invalidation point for that thesis. Like I said earlier, you know that you're not going to be right in all of your trades. You know this. And so every time that you take a trade, the moment where your trade is wrong has to be incredibly clear to you before you take the trade. And the next step after that is to size yourself correctly. Because once your thesis is clear and once your invalidation point is clear, is to size yourself accordingly so that you're both making the correct amount of money if this trade works, and so that you don't find yourself with outsized losses before your trade even becomes invalidated. And then the last piece of this framework is that when the invalidation happens, and it will happen to a double-digit percentage of your trades, you have to execute the stop loss without negotiation. So super general examples are, if you're following a trend strategy, well, the first time the trend creates its first high or low, that's your sign. Or if you're trading ranges, then the stop needs to be below the range. If it's a breakout-based strategy and it broke out, tested the breakout level, and then didn't respect it, you got to stop out. Now, your stop has to make sense with what you're doing. It needs to make sense with the volatility of the instrument that you're trading, with the liquidity of the instrument that you're trading. Your time horizon has to match. The time horizon with which you took the trade has to match the time horizon with which you take the stop. And if you want to know if you're really okay with taking losses, don't listen to what you say. Look at what you've done historically while you were under pressure, because behavior doesn't lie. So let's go over the most common behavior that prove that you're not okay with taking losses. Number one, break-even addiction. If you find yourself having losers and looking for that break-even exit instead of exiting where the invalidation point happened, that's a problem. Number two, stop widening. If you find that your trade has gone to where your stop was, but you move your stop, that's a problem. Time frame switching. If you went into this trade thinking it's a day trade and now you're starting to hold it for a swing trade because the day trade isn't working, or any other kind of time frame switching, that's a problem. Averaging up or averaging down, whether you're long or short. If the stock moved to your invalidation area and you're adding, that's a problem. Oversizing. If you miscalculated where your invalidation area is to begin with, and now it goes there and the loss is too big and you just don't want to book it, that's a problem. Stop hunt narratives and other kinds of excuses. If you start to come up with excuses for why things aren't working for you and you start with the tinfoil theories, that's a problem. And finally, ignoring liquidity risk, news risk, halt risk, and any other kind of obvious risk that's staring you in the face, that's a problem. Now, here's the good news. You don't fix this by becoming tougher or anything like that. You fix this the same way you fix every human issue, with practice, with repetition. So let's go over the rewiring plan, the drills that will help you rewrite your emotional response to these situations. Now, if you took an honest look at yourself when I listed the common behaviors that prove that you have an issue with taking losses, and you know that you do have this issue, then the first drill to rewire your emotional response is to size down for the next 2 weeks and then have extremely crystal clear definitions of where you should stop out on every new trade that you take. And then on trades that do go to your stop out area, you stop out immediately without any negotiation, without any thought whatsoever. And even though you may absolutely hate the idea of trading small for 2 weeks, the idea is that you have to rewire your emotional response. And the way to do that is through repetition in real life situations. And the way to actually make you follow that plan is to reduce size. And so, yeah, it's going to suck to trade small for a little while, but you're doing it for a very good reason. You're rebuilding your reflexes, your emotional response. And so hopefully you trade and you trade and you trade small. And when you're right, great. And when you're wrong, you book that loss immediately in the moment where you know you should. And you do that over and over and over until it starts becoming the new reflex. And you should keep yourself accountable. Every time that a stop out moment happens, you should log whether you took it immediately when you should have or not. And even though I said you should trade small for about 2 weeks, the truth is that you should stay small until you have enough proper stop outs under your belt. Meaning to say that, let's say 10 or 20 situations happen where you needed to stop out and you did. And if you stopped out where you should for 10 times in a row or whatever, then you can say to yourself, okay, I can increase sizes as long as I continue the same behavior. But if you find yourself cheating even on small size, then honestly, you haven't earned the right to go back to your increased size. And another thing to consider is the 5-second rule. This is a rule I used a lot while building my emotional response mechanism to losses. Now, nowadays, I don't use manual stops. I use automatic stops, and we will absolutely get to that in this video. But back in the day when I used to use manual stops, or when I used to use automatic stops and then move them a little bit when they were about to get hit, then what I would do is once the trade goes to its invalidation area, I would give myself 5 seconds to stop out. Because the issue is I didn't want to stop out, right? So I would put my finger on the trigger of the stop out and I would count 1, 2, up to 5. And if the stock is still trading where it shouldn't be trading for my thesis, I force myself to click after 5 seconds. The next drill to work out is the no break even challenge. The no break even challenge is a challenge that you're going to give yourself where as soon as something goes to the invalidation area and your reflex goes to, okay, I'll just hold it till it breaks even. I'll just add and hope for like a little bounce and then get out there. You have got to shut that thought off right away. You have to immediately tell yourself no. And I actually don't know how to train for that, what the drill is. And so I'm going to leave that one up to you, but find however you can do it to just every time that that thought comes up in a situation where you're supposed to stop out, you need to sort of laugh at yourself and be like, oh man, no, 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 no. I definitely am doing the wrong thing if I'm thinking about waiting for break even once the invalidation point happened for this trade. Now, the next drill is super easy and should become a habit for you. Every time that you enter a trade, already put in the stop loss because there's a psychological thing that happens if you put your stop loss immediately once you put in your trade. It forces pre-commitment and it removes that, oh, I'll decide later from your brain. And the last thing that you should add to your process is a max daily loss. There has to be a number that if you lose that number in a day, you are done for the day. And that number needs to be somewhere in the area of whatever it is that you make on average in a week or less than a week. For me, that number tends to be around 3 to 4 days. Whatever I make on average in about 3 days or so, if I lose that in a single day, I'm done for the day. No questions. Personally, I like drills. I like systems. I like stuff written down. So I'd recommend that you write all these recommendations down, follow them, and then hold yourself accountable to whether you followed them or not. If you can hold yourself accountable, that's great. If you can get an accountability partner, that's even better. But you have to know what you're trying to do. It has to be clear so that you can see if you're fucking up here or cheating there. Then you got to try harder. Then you got to come back and redo this process until you get it right. Because we're not trying to avoid losses. The goal is to make losses boring. So things you can measure in the coming future is how many times did you widen your stop? How many times was your average loss substantially bigger than 1R? How many times did you delay your stop loss from the moment that it became necessary? How many times did you wait until breaking even in order to leave a trade you know you should have left? And what's your clean stop out rate? Of all the stop outs that you took, how many of them were clean and how many of them you cheated on? As a percentage, more than 50% clean, less than 50% clean. Your goal is to get to 90% clean stop outs. And so if you create yourself this sheet and grade yourself, hold yourself accountable for all these metrics, and you start with sizing down so that it should be easy for you to score high on these metrics, after a while, the results of this scorecard will tell you, hey, you're ready to increase size, or no, you're not ready yet. Keep working on it. And personally, I think the trading size is a privilege that you earn only once you've proven to yourself that you can manage risk properly. And these are the frameworks for managing risk properly. Now, I want to touch on social media as an issue here, because on social media, almost nobody shows losses. And that's one of the biggest problems in trading, is that everybody shows you what a winner should look like, but you rarely see people show you what a loser should look like. And you know exactly why that is. It's because people are being dishonest to themselves and to you. So I want to go back to exactly how I started this video by telling you that the difference between the traders who last and the traders who disappear is that traders that last take losses like it's nothing. It's second nature. They don't get excited about it. They take it, hell, they even accept it with love. I know I do. A lot of times I get stopped out and I'm like, y'all got me, motherfuckers. And I move on. And that's the ideal that you should build in your mind, not the ideal that's sold on social media. You should start realizing that a good loss is something to be proud of. It's something to post on social media. Look, I cut it right when I was wrong. That's a great trade. If you do that, if you fix this area of your trading, then you will fix the area that is responsible for most of the reason why traders fail. Because they fail for two reasons, either never developing a strategy or never developing good risk management. The biggest problem with good risk management is our emotional wiring. All right, so let's recap what we talked about today. The traders who last aren't the ones that avoid losses. They're the ones that take small losses immediately because they're really okay with being wrong. Your brain is wired to do the opposite of that. Prospect theory makes you willing to take big risks when you're down on your position just so that you break even, risks that you wouldn't be willing to take when you're actually right on the position. And the disposition effect makes you cut winners quickly and hold on to losers for too long. That wiring creates the negotiation spiral where a normal loss turns into a way too big of a loss. The solution is to rewire your relationship with losses. Make small losses normal, procedural, and non-negotiable, and then enforce that with stop rules and sizing rules. Whenever you take a trade, define your thesis, define your invalidation of that thesis, set your size based on the distance to your stop, and execute without negotiation. If you need help removing negotiation, use automatic stops. For the next few weeks, don't focus on your P&L. Focus on one thing. Did you take the right loss when you should have? Now go run the drills. Small size, clean stop outs, no break even, and max daily loss. Track your clean stop out rate, your exit delay, and whether you widen your stops. When those metrics improve, your trading improves because your worst possible outcomes disappear. And if you want accountability, we have a Discord room. Come join people that are going through the same journey that you are. I'm Mo. Thanks for watching. I'll see you in the next episode.